rate system in Indian banking. In this session, we are going to cover bank rate, base rate system, and deposit interest rates. So first of all, we see the interest rate segments. In Indian banking, the interest rate fall into two categories. The first category of interest rate is called regulated interest rates. Regulated interest rates are those interest rates which are fixed by Reserve Bank of India. So here, banks apply those interest rates which are fixed by Reserve Bank of India. Banks do not fix their own interest rate in certain segments, so they are regulated interest rates. As against regulated interest rate, we have another category called deregulated interest rates. So deregulated interest rates include those interest rates which are fixed by individual bank boards. And most of the interest rates in the present Indian banking, they fall in deregulated interest rate category. So first, bank rate. What is bank rate? Bank rate is fixed by Reserve Bank of India. This rate is changed from time to time whenever Reserve Bank of India changes repo rate. So whenever repo rate is changed, bank rate is linked to repo rate and automatically the bank rate is changed. What is bank rate? How do we define bank rate? Bank rate is the interest rate which Reserve Bank of India recovers from banks when banks rediscount commercial bills or instruments with Reserve Bank of India. So whenever banks come to Reserve Bank of India to raise money by way of rediscounting of commercial bills or commercial instruments, then that rate of interest which RBI recovers from banks is called bank rate. Now, to clarify, what is rediscounting? So rediscounting is a process in which banks discount bills of exchange from borrowers and accordingly they pay money to the borrowers, and against that loan they raise loan from Reserve Bank of India. So they get funds from Reserve Bank of India. That is called rediscounting of commercial bills, and rate of interest which Reserve Bank of India is recovering from banks on this rediscounting of commercial bills or instruments is called base rate, bank rate. So bank rate, it is the rate which is fixed by Reserve Bank of India. Now base rate. Base rate is the basic interest rate which banks charge on loans given by them. So whenever banks are giving loans, they recover interest, and that interest rates are the basic rate, that is called base rate. So base rate is the basic rate which is charged by banks on loans given by them. Base rate is fixed by board of directors of the concerned banks. This means all banks have different base rate. So base rate is different with all banks, whereas bank rate is decided by Reserve Bank of India. It is uniform for all banks. Banks cannot charge rate of interest on loans below the base rate. So whenever banks are sanctioning loans, the rate of interest which they recover from borrowers, it cannot be less than base rate. However, there are certain exceptions to the general rule. So there are certain loans which are specifically exempted, which can be less than base rate also. In general, banks cannot charge interest rate on loans below the base rate. Actual interest rate charged by banks is not the base rate. Base rate is the minimum base amount, interest rate. So actual interest rate which banks are charging is something like this. So base rate plus some premium. It means in most of the loans the rate of interest will be more than base rate. Now base rate is fixed by banks taking into account certain factors. So these factors are: number one, the cost of funds, that means the cost the banks are paying on raising money. Then operational cost, the cost they pay to manage these funds. Then risk cost, so there is some cost of risk also which banks have to bear. So when they fix base rate, they take into consideration this cost also. And lastly, return on funds, how much profit they want to earn. So these are four factors which broadly banks take into consideration when they fix the base rate. Now interest rate on individual loans. Whenever banks are charging interest on individual loans, then it is charged by adding risk premium to the base rate. So from individual borrowers, the interest rate is charged as base rate plus some risk premium. Risk premium is determined on the basis of credit rating of the borrower. So banks have a system to undertake credit rating of the borrower. How do they consider an individual borrower? So there is credit rating system. So based on that credit rating of the borrower, they determine the risk premium. So for good credit rating, the risk premium will be low, and for not so good credit rating, the risk premium would be high. That means for low credit rated borrowers, the interest rate would be higher, and for high credit rated borrowers, the interest rate would be low. Interest rates also vary according to the time period for which the loan is given. So banks provide short-term loans, and banks also provide long-term loans. So the interest rates also vary according to time period for which the loan is given. Normally for short-term loans, the interest rate is higher. Now interest rate which the banks charge, it can be fixed rate which does not change during the period of loan, or it can be floating rate. So if it is a floating rate loan, then this rate of interest is reset periodically. Now interest rate on deposits. For the purpose of interest rate, deposits can be segregated into three categories. So the first category is current deposits. Second category is saving bank deposits. And third category is term deposits. On current deposits, no interest is paid. On saving bank deposit, interest is fixed by banks themselves, and it is paid on daily product basis. So saving bank deposit rate is fixed by banks themselves. It is in the deregulated category. On term deposits, on fixed deposits or on recurring deposits, so on term deposits which comprise fixed deposits and recurring deposits, the banks fix rate of interest themselves according to maturity period of the deposit. Normally for shorter maturity period, the interest rate is low, and for longer maturity deposits, the interest rate is higher. In fixed deposit cases, if fixed deposit is encashed before maturity, banks pay interest applicable to the corresponding maturity, and they also deduct penalty if any. So if fixed deposit is encashed before maturity, then banks pay lesser interest, and they also recover penalty for prepayment. Thank you friends for watching this video. I hope the contents have benefited you. In case you want to know more about banking related issues, please log in our website, or you can call us or email us. Thank you once again.